Let's get some insights on the news shaping the markets. For that, we welcome in Ahmed Riesgo, Chief Investment Officer at Insignio. Thank you for being with us. A turnaround in the market. Look, we have seen that inflation has been sticky. Today, we got a little bit of a light of a number from the ISM, and the market's really, I guess, like that after 2 days of selling. What's your interpretation? How are you feeling right now?
Yeah, so I think the disinflation trend is still in place. I think we're going to see here in the next couple of weeks and months that those January bumps in the figures were nothing more than a seasonal effect, but that the overall trend of disinflation is still in place. And I think the Fed is going to be able to cut rates the way they've been telling us by the June meeting, sometime around June. It's really not all that important whether it happens in June or at a later meeting. I will say that given the fact that they've kind of already signaled to the market that the June meeting is when they're going to start cutting, I think the bar is going to be very high for inflation to surprise to the upside for that not to occur.
Yeah, look, I know people are thinking June, but you have more people than not saying to push it back. And that, we're sort of in this Goldilocks era right now, and you could still see inflation once again. Why not just push it off until later in the year?
Well, there's two reasons I think why the Fed is sort of in this position, or in this predicament, I should say. One is that there is an election coming up in November, and I know that the Fed strives to be apolitical, but the closer that they do this rate cut to the election, the more likely it's to be interpreted in a political fashion. Already in June, it's likely to be interpreted that way by some elements of society, but they cannot wait too long. The other reason is that the Fed does not like to surprise the markets. Right now, there's roughly a 64% chance that the market is pricing in for that rate cut in June. If the Fed were not to cut in June, they're going to come out forcefully here and signal to the market that they're not going to do so. They'll either do it by leaking a story to the Wall Street Journal or perhaps some other publication out there, but they're not going to want to go into that meeting where the market is sort of sitting 50-50 on this. They're going to come out and either confirm that they're going to cut in June, or they're going to come out with a strong statement against.
Where does oil fit into this picture as we're at the highs of this year at 85.74? You have the meeting of ministers. Your thoughts on where oil is headed and how that may factor in?
Yep, I think oil has a sort of very strong floor here. I don't see much downside for it all, even in case of weakening growth. And that's partly due to the very tight supply-demand dynamics that are occurring right now in the oil market. Something that's sort of going under the radar here, I'm not sure why, is the effect that the ongoing war in Ukraine is having on the oil price. Remember, Ukraine for the last several weeks has been bombing Russian facilities and has taken, I think, effectively roughly 500,000 barrels per day of Russian production offline through these attacks. And Ukraine has signaled repeatedly out there to the public that they believe that these targets are legitimate military targets because they're funding Russia's war machine. So I expect these attacks to continue. I see no reason for Ukraine to pull back. I think the U.S. government will try to apply pressure to Ukraine behind the scenes to scale back these attacks, because the last thing President Biden wants is for oil prices to continue to grind higher here before the election. But I don't think there's going to be much that the administration can do given the military situation on the ground in Ukraine.
And then we get to the jobs picture. Of course, we're waiting on the important jobs report on Friday for non-farm payrolls. But how did you feel? Look, we have ADP today. We had JOLTS yesterday. How do you see the labor picture, and what are you focusing on now?
Look, the labor picture remains quite strong. The thing with the labor market is you have to remember it's strong until it isn't. And the unemployment rate is a highly mean reverting series. Which means that it doesn't stay down long for a very long time. It tends to shoot higher. And when it goes up, it will come down. It's mean reverting in that sense. So I wouldn't focus too much on what the unemployment rate has been telling us. Remember, it's sort of backward looking. And there's also some issues as to whether or how accurate that number is, given the increased labor force participation rates that we're seeing throughout the country. So I wouldn't put too much stock into that. I would put more stock into other real-time indicators of labor market demand. those are quite strong, but they are weakening on the market. We do expect the labor market to continue to deteriorate throughout the year. We expect sort of payrolls to land anywhere between 150,000 per month, which is slightly lower, about 50,000 K per month lower than the averages we've seen here recently. All that implies a weakening labor market until it will get to the point, the tipping point, at which layoffs commence, which is something we do think will start either later this year or the beginning of 2025.
And what's your advice to investors here for 2024? I don't know if you have near term and longer term.
Yeah, sort of in the, tactically here, sure, the market could continue to grind higher, although technically it doesn't look very attractive. It's sort of due for a pullback if you look at the technicals. Um, but even if the United States avoids a recession, which is a possibility, I'm not saying that our recessionary call is ironclad. But even if the U.S. avoids a recession, we simply just do not see too much upside to U.S. equities here. In fact, we're sort of in the range right now of what we think the equity market should be trading at without a recession. If a mild recession occurs, we expect the equity market, the S&P 500, to trade somewhere between 4,100 and 4,300, which is significantly lower than here. So as an equity investor, we don't see many compelling stories. Where we do see compelling stories is on the government bond side. And I know many of you have been out talking, especially today, about the fiscal situation. And I agree with you. In the long term, the fiscal picture for the United States is worrying, and it likely means that rates are heading higher. But in the short term, on a tactical basis, we do think there is an opportunity to add duration here. We like the U.S. long bond at these levels, the 10-year at these levels. We think under any scenario, a recession, mild recession, no recession, severe recession, we think the U.S. 10-year bond will be lower than where it is today in 6 to 9 months' time.
And I'm glad you brought up the fiscal picture, because I think that is actually a bigger story. We don't talk about it enough. You gave it a sentence, right? And meanwhile, it deserves its own show. And I'm glad you brought that up. And that's one of the things that voters are actually concerned about on both sides of the aisle, Ahmed. Thank you for a wide-ranging conversation. Ahmed Riesgo of Insignio. Thank you.